Fusion Mobile, quality e-learning experience on the go.
Central bank and specialized banks. The central bank is the highest financial institution in a country which implements the monetary policy of the government. The central bank controls and regulates the supply of money. Most countries like Nigeria have their own central banks which work closely with the government in order to have means of influencing the credit policy of commercial banks. The historical development of central banks in West Africa. In West Africa, before independence, the West African Currency Board was the highest financial institution which performed the functions of the central bank. The board controlled the issue of currency in the member countries. The goal was to keep the currencies of West African nations at equality with the pound sterling. After independence, the countries set up their central banks to ensure rapid economic development. The Central Bank of Nigeria was then established in 1959. It was charged with the management of the country's currency. It supervises and coordinates other financial institutions in Nigeria to facilitate economic development. The report submitted by Mr. J.B. Loynitz in August 1957 gave rise to the establishment of the Central Bank of Nigeria. The characteristics of central bank includes 1. Central bank is not profit-oriented. That is, their major goal is not to make profit. 2. Only one central bank exists in a country. The central bank is the highest financial institution in a country. The central bank is established by the Act of Parliament. The central bank is owned by the government. And also, there is no transaction with private individuals in the central bank. Functions of the central bank includes 1. The central bank acts as an agent and banker to the government, in that it controls public accounts, receives revenue on behalf of the government, and makes payment from these accounts. The central bank also obtains loan on behalf of the government. The central bank has the right to order the printing of the currency and the issuance of it. It controls the circulation of currency, exchange of bad notes for new ones, and sees to the destruction of the bad notes. The central bank acts as banker to the banks by ensuring that the banks open accounts with it in order to facilitate clearing of checks. This helps the commercial banks to have similar facilities to offer their customers. The central bank has a duty to assist the banking system when the banks are in financial difficulties so that they can stand the strain of excessive demands. In some countries, the banks can borrow directly from the central bank. Therefore, the central bank acts as the lender of last resort. The central bank holds the foreign reserve of a country, and this helps in enforcing foreign exchange control regulation. It operates the exchange control, which is set up to purchase and sell foreign currencies. Therefore, the central bank is also involved in foreign exchange transactions. The central bank is also responsible for the monetary policies of a country. It can use both the expansionist and the restrictionist policies to control the quantity and value of money in circulation, so as to influence the level of production and distribution of the national income. The central bank also formulates rules and regulations guiding the banking industry. The central bank acts as agent of the country by relating with other countries and international financial institutions like IMF, World Bank. The central bank also does other functions, which includes acting as a clearinghouse for other banks and the management of the national debt of a country. How central bank controls commercial banks. The various ways by which the central bank regulates the activities of the central banks are through the open market operation. Open market operation, OMO, is the purchase or sale of government securities on the open market so as to expand or restrict the volume of money in circulation. The central bank applies this policy with the aim of regulating the volume of money in circulation. When there is too much money in circulation, the central bank will sell securities, but in order to expand the volume, it buys securities. Another way by which the central bank regulates the activities of commercial bank is also through liquidity ratio or cash ratio. The commercial banks are mandated by the government to keep special proportion, for example, 25% of their total deposits with the central bank in order to control the volume of credit. The size can be expanded or contracted depending on the economic condition. Another way is through bank rate. Bank rate is the minimum rate of interest charged by the central bank for discounting bill of exchange. By lowering or raising the rate, the central bank can control the activities of the commercial banks. When the rate increases, loan to the public, that is customers, reduces, while a fall in the rate will encourage more loans. Special directives is another way by which the central bank regulates the activities of commercial banks, in that the central bank can issue direct or specific instructions to the commercial banks and other institutions to restrict their lending or credit policy or on the direction to which lending should follow. They will be told to direct their funds to sectors which are in need of investment. Special deposit is also an instrument of monetary policy which is used to restrict lending. The central bank can order the commercial banks for special deposits, usually a percentage of the bank's deposit, to be made with it. This is intended to control credit and is often used during the period of inflation to reduce cash with banks. The central bank will mandate the commercial banks to keep special deposits over the statutory requirements. The central bank can just appeal to the commercial banks to restrict or expand the level of credit to the public. Moral persuasion is not based on the use of force, but an appeal to restrict or expand the lending policy. This is another way by which the central bank regulates the activities of commercial banks. Bank Clearing House. Bank Clearing House is an institution established by member banks to simplify exchanging and obtaining payments for checks that are paid into banks branches throughout the country. The clearing system is used among banks to settle checks drawn on them. Indebtedness between banks as a result of the differences between the daily totals of checks exchanged are set off against each other. Final settlement is effected through the bank's account. There are different types of clearinghouse, and they include the local clearinghouse, the head office clearinghouse, the banker's clearinghouse. The local clearinghouse takes care of clearance of checks among various banks in the same town. All large towns have their own clearing houses where representatives of the various banks in the town meet each day to clear checks. The head office clearing house is a clearing house that undertakes to settle checks drawn by the customers of a bank from various branches, while the banker's clearing house is the place where ultimate clearance and settlement of checks are carried out in a country. All banks in the country will come together to sort out checks drawn on each other. The final settlement is through checks drawn on the central banks. The specialized financial institutions are institutions specialized in an aspect of financial activities for which they were established. The institutions are the development banks, the merchant banks, the mortgage banks, and the savings banks. The development banks, as we've earlier discussed, are specialized financial institutions which provide long-term credit or loan to other enterprises for capital projects. Merchant banks are institutions which perform specialized functions such as the acceptance of bills of exchange, the issuance of loans for foreign trade transactions, the issuance of new shares, and the provision of medium and long-term loans. They are sometimes referred to as acceptance houses. The mortgage banks are financial institutions that specialize in granting loans to individuals and corporate bodies for building purposes, while the savings banks are financial institutions which are set up to encourage saving habits among the people and help mobilize funds for finance development programs for the government. The capital market. The capital market is a market for medium-term to long-term loans. It serves the need of the industry and the commercial sector. It comprises all the institutions which are concerned with either the supply of or demand for long-term capital. Instruments used in capital market are mainly stocks and shares. Stocks and shares are securities purchased by individuals, which is an evidence of contributing part of the total capital used in running an existing industry. Institutions involved in capital market include issuing houses, insurance companies, development banks, building societies, mortgage banks, national provident funds, that's the NPF, the stock exchange, and the agricultural banks. Advantages of the capital market are: 1. It provides long-term loans to the private and public sectors for investment. Savings are mobilized in the capital market. The existence of capital markets helps the growth and development of merchant banks. The existence of capital markets encourages the general public to participate in the running of the economy of the country. The new issue market is part of the capital market, which deals with new public issues of securities, for example, stock, shares, etc. Methods of issuing securities include private placing. Private placing is the taking up by an issuing house, finance house, or group of institutions of a new public share issue in its entity. Another method is by introduction. The company concerned can apply to the stock exchange for sales of their shares. In this case, there will be an offer to the public of a new issue of shares through the stock exchange. By prospectus, the Company Act requires a prospectus to be issued. The prospectus will show the relevant information about the company's affairs, its development in the past, and future prospects. By tender, this is a process of issuing shares in which applicants have to put in a tender stating the price at which they will be willing to purchase them. They are issued to the highest bidder. Another method of issuing security is by right issue. Right issue is a cheap and convenient means of raising capital.